Welcome, everybody. Good afternoon. I'm Russ Seagle. I'm the Executive Director of the Sequoia Fund. I'm your host for this special edition of Live with Sequoia Fund. And the doctor is in the house. I'm here with Shawn Spruce. He's going to be our mentor and guide today as we talk about some of the crazy things that have been going on. You've probably heard about them in the news. A lot of it has to do with GameStop. And I got to tell you, Shawn, like I've mentioned before, this is my impression of GameStop, and we're going to talk about how the little guy may have turned all that around. We don't know. But as we get into it today, I want to offer a few disclaimers. Number one, we're not going to sell you anything. This is not one of those things where we're going to talk about this and offer you some kind of investment to buy into. We're not offering investment advice. Please don't construe any of this as investment advice. If you need investment advice, please talk to a licensed, certified investment counselor or a broker, somebody who has a lot of initials behind their name and is qualified to do this legally. And this is not a substitute for your econ class. So you're going to have to do your own homework. We're going to have a lot of fun today, I think, talking about some things that are of relevance to you as investors, to all of us, really. And we're going to learn a lot because, like I said, the doctor's in the house. Dr. Percap is going to walk us through the good, the bad, and the ugly of what's been going on, educate us a little bit on what this means for us and how we should treat things going forward. And Shawn, before the show, we were talking about some of the ups and downs that we've had with individual stocks. And, I think we could probably agree that betting on individual stocks is not the smartest investment move. And I know you're going to talk more about that, but you've got a couple of stories about dealing with individual stocks. How about start us off by regaling us with some of those stories?
Absolutely, Russ. So I started investing back in the mid 1990s. So we're talking like about 25 years ago, I guess it was. And it was around the time when the internet was first starting to taking off. And there was just a lot of information out there online and how to invest and information about stocks. And so I just really started educating myself. And I started off like most people buying mutual funds. And I remember Black Monday of 1997 when it was the 10-year anniversary of the first Black Monday back in 1987 when there was that huge crash. And I had a broker at the time in Albuquerque, and I called him and, hey, what are some good stocks to buy? And he said, well, he recommended a couple. So I think I had about $1,000. And that was the first time I actually bought an individual stock. And then I kind of got more interested in that. And in the late 90s, I dabbled a little bit in penny stocks, and it was actually a hot tip. I got a hot tip from a 16-year-old kid that I used to work with in a pizza store. Okay, so I think that'll pretty much set the story that this probably doesn't end so well, right? When you're taking hot tip stocks from teenagers that are making pizzas in the evenings. But at any rate, it was a stock. And it was a media company. And I'm going to try and tell this story and maintain at least a shred of dignity here. So I'm not going to tell which stock it was, what the company was, but it was a media company, a controversial media company, I might add. And they were based in Europe. And at the time, their stock was trading for about $4 a share. So it was a penny stock. Technically, any stock that trades for less than $10 is considered a penny stock. So I bought this stock. I put about $7,000 into this stock. And the idea was that, it was a cool media company and it had a lot of opportunities and things were really going to happen. And sure enough, the stock shot up. And within about 3 months, my initial investment was worth almost $30,000. So I got excited, oh my gosh, here it is. My ship's come in. I'm just going to ride this thing all the way. So I didn't sell. I held on. But at one point, I could have probably, more than tripled my investment if I had sold. But I didn't sell. I held on. And it was just this small stock, and there was some play. There were some investors involved. At one point, there was a rumor that Napster, it was Napster was going to buy it. They were going to use their platform, their online hardware to like build Napster and stuff like that. And that kind of pumped the stock up. But eventually it just all fell apart. It was just, as I said, it was based overseas. The financials were horrible. And the stock just plummeted and plummeted. It dropped down to the point where I was still up a few $1,000, and then it dropped to where I was about even. And I just, as long as I'm in, I'm just going to stay in. So I rode that thing all the way to the bottom, and it dropped down to below $1 a share. At that point, it had a reverse split. So rather than a stock splitting and you owning more shares, it splits and you own less shares. Bad. The way it was just bad. And I ended up losing pretty much everything. It got delisted, so it was no longer something I could even trade. So yeah, I lost, a few $1,000, more than a few $1,000 on it. But it was a lesson learned. And since that time, I've never dabbled in penny stocks again. I mean, I don't know. Maybe it's a good thing. Maybe it's a bad thing. You hear that old Mark Twain quote. If a cat jumps on a hot burner on a stove, it'll never jump on a hot burner again. But then again, it'll never jump on a cold burner again either. So that's kind of my position. And I mean, to make lemonade out of lemons, when I did buy my house about 5 years ago, I did sell some investments. So I took some capital gains, and I had some capital gains taxes due for those investments that I sold. And I was able to just take those losses from that, because I had it in a TD Ameritrade account. I was able to take the losses on that penny stock to offset those capital gains. So that was, a little bit of a plus. But yeah, I got burned pretty bad. And again, it was a tip from a 16-year-old kid.
Yeah. What were you thinking? Actually, he wasn't wrong, though. He just wasn't right for long enough, right?
Right. If I'd gotten out sensibly, early on, and but you just never know, how high this thing going to go. I mean, this could just be getting. You don't want to be that guy that, I sold a stock at $30 a share when it went up to 100. You don't want to be that guy.
Yeah.
Yeah.
But now you've had a couple of other. You said this was your last dabble with penny stocks, but you've bought some individual stocks. I think you bought some as gifts that turned out okay. Tell us a little bit about that.
Yeah, we bought some stocks, Brooke and I, for Christmas gifts back, and it was actually a good time to buy. I think it was in the Christmas of 2013, so it was right before this current bull market really took off. And we bought stocks as Christmas presents to Brooke's family members, and we bought stocks that they had interests in as companies. So like one of Brooke's sisters really likes Nike. We bought her Nike stock. Another one of her sisters likes Coca-Cola. We bought her Coca-Cola stock. Her dad used to like hot rods and fixing cars. We bought him Snap-on stock. And it was cool. We bought small holdings in each one. And right after Christmas, we transferred them to them in their names. And most of those stocks, with the exception of Coca-Cola's been pretty flat since that time, but Nike's gone way up, Snap-on's gone way up. Those have been really good stocks now, and it was cool because I remember that spring, a few months after Christmas, we all got together for lunch, and all anybody wanted to talk about was those stocks that they'd gotten for Christmas and how they were doing. So
that's a great Christmas gift. I think that's awesome, except for the flat Coke. Nobody likes flat Coke. we want that Coke to be nice and fizzy. And I actually have a Coke story of my own. My father worked for Pepsi Cola for 42 years. I mean, it's unheard of to work for the same company for that long nowadays, but it was, he's a baby boomer. So he worked for the same company 42 years. And when we were buying some individual stocks back in the late 90s, early 2000s, I kind of had this loyalty, to the company that put clothes on my back and food on the table as I was growing up. And my wife, listen, every time I've ever messed up, it's been something that she said, let's do this. And I said, nah, let's not do this. Or it's something that I've said, hey, let's do this. And she said, no, let's not do that. So anytime I've gone against her judgment, it's been the wrong thing. But she said, we should buy Coke. Coca-Cola is getting ready to explode. We should do that. And I said, no, I've got this loyalty to PepsiCo. So we bought PepsiCo instead. And PepsiCo, again, flat for a while. And then it started to slide. And the whole time, every day she was bringing me the charts, and she's going, look what Coke's doing. Coke is just going up. And so that emotion, that that loyalty that I felt to a company did not translate to a really smart decision for my investments. But as investors, we hope things are going to go up, right? We want our money to increase. We want that investment to get bigger. And as we get into the main topic today, I want to talk about a kid named Jaden Carr. This kid, when he was 8 years old, 2 years ago, his mother bought him some GameStop stock at $6 a share. And a couple of weeks ago, he decides that last week, he decides that he's going to sell this stock. He and his mom watched this stock. It was a gift, just like you gave gifts to your friends and family. He's watching this stock, and it hits 53 times its original value. And she asked, she was trying to, this is part of the education, right? She's trying to educate him about stocks and how the stock market works. And she said, do you want to stay or do you want to sell? And he said, I think I want to sell. So he got out at 53 times the value. He cashes out $3,200. Now the kid doesn't run down to GameStop and buy all the games, right? He puts $2,200 into a savings account for a rainy day, and he takes $1,000 and he's going to buy more stock with it. So he came out to the good, like all investors want to do. Or should we say most investors? Some investors are actually betting for things to get worse. How is that? Why is that? And let's talk a little bit about the topic at hand.
Yeah, so there is, investing terminology. They describe when you invest in a stock, you can either go long on a stock or you can go short on a stock. And going long on a stock is investing with the expectation that stock's going to go up in value. And going short on a stock is investing with the expectation that it's going to go down in value. And it does sound crazy, like why would you invest in a stock when it goes down in value? But that's kind of the real nitty gritty aspects of investing, and investing pros is they know how to make money when the markets are going up, and they know how to make money when the markets are going down. They really have that ability to make lemonade out of lemons, so to speak. So just because a stock is performing poorly, you can still make money on it. It's called a short sale. And it's a lot harder to make money on a stock on a short sale than it is when you go long. It's trickier. It's tougher to do. But the idea is that you can go out, you put your eye on a stock, like let's say GameStop, for example, and this is what happened over the last couple of years. You had a lot of these big institutional investors, hedge funds. These are specialized types of investment funds for very wealthy investors. And they're known for taking a lot of risks. They have a lot more flexibility, and they have a lot more leniency from regulation in terms of what types of investment products they invest in. And they have very complex fee structures. And boy, when the markets are hot and those fund managers pick the right investments, those things can shoot to the moon. But likewise, they can be really risky and you can lose a lot of money. And in order to invest in a hedge fund, you've got to be what they call an accredited investor. And that's somebody that has an annual income of at least $200,000 a year or a net worth of over $1 million. And the idea is that an accredited investor is somebody that's got that cash cushion, and they can take the risk, right? They've got enough money that even if they make bad decisions or their investments perform poorly, they've got that cushion to take care of them. So these hedge funds shorted GameStop because, like you said, I mean, it's this old business that dates back to like the Blockbuster video days. And who goes into GameStop and buys games anymore? Now everything's downloaded and they stream games and people play on their computers, and they're not buying consoles like they used to. It's just this completely outdated, antiquated business, right? So they think GameStop's going to go down in value. So what they do is they borrow shares of GameStop. And you can do this. You can go through a brokerage and you can actually borrow shares of stock. So they borrow the shares. And then as soon as they borrow them, they sell them. And it seems kind of crazy. Like what, you borrow stock, somebody else owns the stock, and then you sell it? But yeah, that's what they do. They sell it with the expectation that the stock is going to go down in value, right? So maybe they buy it, maybe they bought it at $10 a share. Or not bought it, I'm sorry, they borrowed it at $10 a share, and they sold it. So they pocket that money. And then if the stock goes down in value, they simply buy it back. They buy it back for that lower price. So now they've still got those shares. They've got the shares back that they borrowed. So they give those back to the person or the brokerage that they borrowed them from. And then they pocket that difference from what they paid for the cheaper stock that had dropped in value versus what they had, sold the borrowed shares for originally. And they make a profit minus interest. They have to pay interest to that brokerage that they borrowed the stock from initially. And that's called a short sale. And it works. And it works beautifully as long as the stock that you short goes down in value. The problem is there's no guarantee that a stock is going to go down in value after you short it, right? What can also happen is that the stock can go up in value. And then you're in a pinch because you've borrowed their shares, you've got to buy it back. But now you've got to buy it back for more money than you originally paid for it. So you can give it back to the investor or the brokerage that you borrowed it from, and you still got to pay interest on top of that. So you can lose your tail. And the fear is that, okay, maybe the stock goes up $5 and you have to buy it back for $5 more than you paid for it. Maybe it goes up $10 more. Okay, that might not be too bad. But what if it goes up $100 more than you paid for it, or $1,000? Or 10,000. I mean, there's sky's the limit. And that's why they call it, there's unlimited exposure, because in theory, that stock could go all the way to the moon and you'd have to buy it back at whatever price it could potentially go to. You could, in theory, owe, an unlimited amount of money in order to come to make clean on that trade. So they actually have safeguards involved. And when you borrow stock that you're going to short, you actually have to agree that if the stock goes the opposite direction, if it starts going up in value, you agree to buy it back regardless of whether it's gone up or gone. You agree to buy it back. So that investor that you borrowed that stock from, so that they have a guarantee they're going to get their stock back. So oftentimes it hits a trigger, like a strike point, and that might be $10 over what the price is that you borrowed it at. If it goes up more than $10, you have to purchase it back right away. It's called covering a short. And that's kind of how it all works. So that's what happened with this GameStop thing. Is you had a bunch of these big institutional investors, these hedge funds, they had a hunch, or not even a hunch. I mean, they had a lot of data, and read a lot of reports and looked at a lot of financial analyses and saw that the future doesn't look so rosy for GameStop. So they shorted it. But about sometime around early, like last year, some things started happening at GameStop, and there was this one guy, a guy named Ryan Cohen, and he actually is the guy that started the company Chewy, the online pet supply company. And he's a young guy in his 30s, these classic, entrepreneurial tech billionaire stories. He started Chewy. He sold Chewy to PetSmart. I think it was like in 2017 or 20 for over $3 billion. In fact, it was like considered one of the biggest e-commerce acquisition purchases of all time. I mean, it's this huge sale. So now he's a billionaire and he's sitting on a ton of cash. And he's become kind of an activist investor. And these are people that target specific companies that they think they can turn around, or they see opportunities and they want change to happen in these companies. So they start buying up shares, and enough shares that they actually have a controlling influence. And they start, working their way, and they start kind of working an agenda as these activist investors. So this Ryan Cohen, he had his eye on GameStop, and because he thought, with things are changing a little bit. PlayStation it was about to come out with the PlayStation 5. Xbox was going to come out with their next generation machine, and that could create interest, and people might come in and start buying accessories and different things for their gaming outfits and their rigs. So he went ahead and ended up purchasing a 12% interest. He became the largest individual shareholder in GameStop. He owns 12%. As of December of this past year, he owned 12% of all outstanding stock. And it was enough to put him, he got a seat on the board of directors. And when that happened, people started getting excited because this Ryan Cohen, he's got a track record. I mean, he knows all about online businesses. He knows about marketing, e-commerce. People, hey, this GameStop, things might start happening. Things might start, this is good news. So you had different investors. They started putting money into GameStop and they went long on it. They're going against all these previous investors, these hedge funds that had shorted the stock, thinking it was going to be a bad story. Now you have investors coming into GameStop and they start buying stock with the hope that it goes up. And this was all like right around, for the longest time, GameStop was just kind of hovering around $4 a share. It was really pretty much in the toilet. And then kind of late August, early September is when the traction started, when Ryan Cohen came on board and you started seeing traction, and GameStop it's a stock started going up. It got up into, the $10 range, started going up into the teens. And it just was kind of, lingering around there in the $20 a share range. And then come the first of the year, it just blew up. And what happened is you had just this huge, and this is where the story gets so fascinating, is you have this movement right now, social media and investing. And you have different groups, these kind of informal chat room type, social media driven groups and clubs, so to speak. Reddit had a big one called Wall Street Bets. And it's just a bunch of individual investors who go online and they share tips and they share ideas. And they got a hold of this whole idea that GameStop is a hot stock to buy. And there was word that, all these hedge funds are shorting it. So let's kind of stick it to the hedge funds. So they put out the message, buy, buy, buy. So you got all these regular people, individuals like you, me, with a few $1,000 to spend, and they're going on these mobile trading apps like Robinhood, where it's just really easy to trade stocks. You can do it on your phone, and they start buying up GameStop. And then this is something that you're not hearing about as much, but there are also big hedge funds that were going long on GameStop too. It wasn't just a bunch of, the Robin Hood story but these little small investors going up against, David and Goliath. There were big institutional investors going long on GameStop too. But anyways, the stock just goes through the roof. It just blows completely up. It clears $100 a share. It breaks $200 a share. And it winds up, last week, it closed at a record high last Wednesday. January 27th, it closed at 360, was it 300 and just under 350. It was $346.51 a share, I think, just under $351. So it's insane. I mean, billions and billions of dollars of wealth was created within like a 2-week time period.
You've actually got a pretty nice graphic about that, and I want to talk about those. And what I think I hear you saying is that we've got small investors who figured out the rules of the game, right? With these chat rooms, with this Reddit group, Wall Street Bets. Notice the name of the group is not Wall Street Sure Things, right? It's Wall Street Bets. And what happened was they used their own spells against them. And I love this graphic because this is what Wall Street hedge fund managers were feeling last week. They're like, how dare you? How dare you do this? You little peons who think you can play our game. But yeah, it really was, the David versus Goliath kind of the Luke versus Vader kind of thing. But let's talk about some of these graphs. I want to throw some of these up and just let you talk about them. And when you're ready to move on, you just give me the high sign and we'll pop these up. But you've got some incredible information in these that I want to circle back to what you've been talking about. But let's get into some depth here with these. So
yeah, this is a short sale illustrated. So let's say you have $10 shares of GameStop. That's its ticker symbol. It trades under the symbol GME. It's an abbreviated symbol for GameStop. And if I were to borrow those shares at $10 a share, I could short 10 shares. It would cost me, I could sell them for $100, right? So I borrow these. Let's say Russ has them. I borrow them from Russ at $10 a share, and I immediately sell them, and I have $100 in my pocket. And if everything goes well, that GameStop stock drops in value to $5 a share. So now it only cost me $50 to buy them back, 10 shares, $5 a piece, $50. So then I give the shares back to Russ, and I've made $50, and I pay Russ some interest to go with that. So that's how a short sale works in my favor. That's when everything goes according to plan. But if you look at the next graph, it shows what happens when it doesn't go well. And in this case, I borrow the same 10 shares for $10 a share and sell them for $100. But in this instance, GameStop goes up in value. It goes up to $20 a share. So now I got to buy them back for $200. I got to give them back to Russ. So now I've lost $100, right? I've lost $100 because I sold them for $100 and I had to buy them back for $200. And I also have to pay Russ interest. So that's when it doesn't go well. And a short squeeze is when other investors recognize that there's a stock that's being shorted, and they just all pile in. and start buying the stock, making it go up in value. And that causes a squeeze, meaning the people that have shorted it now, they have to sell it to cover all those shorts. And it's nasty business. And it's been happening for years. Usually it's just big hedge funds short squeezing each other and going after each other. Like back when you had the big investment banks that failed during the financial crisis back in 2008. It's usually big name banks, the big guys going against the other ones, almost like that wolf mentality. When one starts limping, they all kind of attack it, kind of like that. It's sick almost. But what happened here is you've got these little regular investors, right? Like you just mentioned, and now they turn the tables, and it's just regular guys on their laptops, individuals on social media. Now they're the ones causing the short squeeze, and that's what's got everybody freaked out. Is it's just regular people. This movement, this social media driven movement of regular people who created this short squeeze.
But we've had, if you go back to the 1600s when the Dutch were starting all of this, there's nothing new under the sun, folks. We tend to look at things in the lens through the lens of what's happening today. And, in the 1600s, the Dutch had all the ships. I mean, they were a naval power. They were a trading power. They traveled all over the world buying spices and silks and trading wool and cotton and everything else. And what they would do is they would say, okay, well, Russ's ship is going to go around the Cape of Good Hope to India, and it's going to be an 18-month voyage. He's probably not going to come back. But Shawn, he's just going to scoot down to the Caribbean. He's going to do some trading down there. He's going to bring us back a ship full of goods, and it's only a 6-month voyage. He's probably going to. So what we're going to do is we're going to take Russ's ship and Shawn's ship, and we're going to insure both of those. And then we're going to put that into one instrument, and we're going to sell shares in that. So basically they were betting on who makes it back alive. And it sounds gruesome, but that really was the origins of what we have today. But let's talk a little bit more about this group of investors, because this particular group, and going back to the Cohens, when you start talking about the people who came on the scene in the last year or so, they're no dummies, right? They saw an opportunity, and there were one or two other people who were watching this in the background who said, maybe it's not as good as they think it's going to be, right? So maybe we should bet against it. And here are the folks we're talking about.
Yeah, the winners and losers in the GameStop fiasco. So let's start with this guy, top center, Gabriel Plotkin. He's a hedge fund manager. He's got a great reputation. He's been one of the superstar hedge fund managers on Wall Street for a number of years. And he's the founder of a hedge fund called Melvin Capital. And it's been a very successful hedge fund. And he took out a huge short position in GameStop over the past year. And when the short squeeze hit, he ended up losing 53% of his fund's value. It was a loss of over $4 billion.
Ouch.
So if he looks a little stressed out in that picture, that's probably why. This guy just to his right, Steve Cohen, he's actually they're colleagues. At one time, Gabriel Plotkin actually, Steve Cohen is also a hedge fund guy. And at one point, Gabriel Plotkin managed one of Steve Cohen's hedge funds. And when Plotkin's got in trouble, when Melvin Capital got in trouble, and they started, on paper, they'd lost all this money. They had to start building up capital reserves because regulators require, hey, if you start losing money in these shorts, you've got to build up a cushion of cash to make sure, you're solvent. So Stephen Cohen, he's got another hedge fund on his own. It's called Point 72. And he, along with another hedge fund called Citadel, they pumped $2.75 billion into Melvin Capital just to keep it solvent. So he's in it with them. He pumped in a huge amount of money. And Cohen, he's a colorful guy, and he's no stranger to SEC investigations. He's been charged in the past with insider trading and racketeering, and he was criticized for getting involved with this whole GameStop thing. And he tweeted, "Hey, I'm just trying to make a living." Here's this billionaire. I mean, this is a guy. Okay, he's a major owner of a major league baseball team. He's got a strong interest in the New York Mets. He owns million-dollar houses, all over the country. He's got an art collection that's estimated at being worth about $1 billion. So, excuse me, this poor guy, what's he?
Yeah.
It's such a hard day at work, stressed out his back having to carry all that money home every day. I don't know. You've got this guy in the corner here, Keith Gill. Okay. Now, Keith Gill, he's a 34-year-old day trader. He's a former college track star. And I guess that's where the headband and the armbands come. Yeah. I don't know. He's like this, your classic, internet, living in my basement, hanging out all the time. I mean, it's exactly the case. He lives in Massachusetts. He actually worked for an insurance company for a number of years. And then he left that job. I'm not sure if he got fired. He left that job. Anyway, over the last couple of years, he's just gotten really into day trading, and he's got this big setup in his basement, and he has a huge following on Wall Street Bets, that Reddit forum that we've been talking about it.
And you won't find him under the name Keith Gill, by the way.
Well, he creates YouTube. He does these live YouTube broadcasts using the handle Roaring Kitty.
Yeah.
So
he also has another handle, is my understanding, has a bit of profanity in the we won't go there. We won't go there, but you won't find him as Keith Gill.
He does. Yeah. And, he's become the face of this movement. He's got this huge following, and he periodically he'll post screenshots of his E-Trade brokerage account. And as of market close last Thursday, he had over $33 million in his E-Trade account, and much of it was GameStop stock, as well as options to buy additional to GameStop stock, and cash. So this guy has made a boatload of money in his basement, and everybody's got, it's like this rags to riches story. His dream is to take some of that money and build an indoor track in his hometown. So he's definitely a winner at this point. We hope he's a winner. I don't really know where he's at now. Did he sell that stock? Because GameStop stock is not what it was doing. It's not where it was at a week ago.
I heard he was considering selling, but the last time I looked, he was holding.
Okay. All right. Well, I'm pulling for the guy. I got a soft spot for him. Maybe it's the headband. I don't know. Ryan Cohen, I've talked about him, right? He's on the board, the largest single shareholder in GameStop. So he's made a fortune on this trade. He's way, way up. Elon Musk. Okay. I mean, anytime there's any drama, anytime we have any kind of crazy stuff happen in the markets, right? Elon Musk is there. And this is the rebel tech tycoon, owner, CEO of Tesla, CEO of SpaceX. And here's another guy, no stranger to SEC investigations, no stranger to inflammatory tweets, no stranger to large SEC fines for spewing, for tweeting before thinking.
Yep.
So he just got it. He just likes chaos. He just likes drama. He just likes to be at the center of things. So he got involved last week, and he was tweeting, encouraging people to buy and hold their positions and crush all the short selling hedge funds. And he blasted out this tweet, game stonk. And that was, part of, that was credited with being a big part of this whole drive to really shoot GameStop stock through the stratosphere faster than one of his big Falcon rockets. So he's I don't know if he's a winner or a loser. I don't think he really cares, honestly. He just wants.
He's one of my favorite lines from any movie is Michael Caine as Alfred, and some people just want to watch the world burn, Master Bruce.
And that's exactly, he's from South Africa. He's got that accent.
Yeah.
Okay. So then we have one more character in this whole drama, and this is Vladimir Tenev. And he founded Robinhood. So he's the one that created this online stock trading platform. It's really mobile friendly. It's almost like a game. I mean, it's online trading has been around for years. Like I mentioned, when I bought that penny stock, I used a TD Ameritrade account. So
right.
For years, you've been able to buy, but now it's just gotten really easy to do. It's almost like playing a game the way they have it set up. And, Robinhood just was this huge force, and they're going to democratize stock investing and the markets, and just eliminate fees and make it possible for the little guy to compete with these big institutional investors. And so Robinhood, it just blew up. This huge following, and a lot of this this stock trading of GameStop was occurring on that platform, Robinhood. And but last week, after everything just went crazy and the stock was just way up, and these hedge fund managers were complaining that they were getting killed, Robinhood restricted trading of GameStop and some other volatile stocks, because there's other stocks that have fallen prey to this same momentum. BlackBerry, the old BlackBerry company, they're one. AMC, the movie theater chain, these struggling companies, it's like fallen angels. So all these volatile stocks, they just completely restricted trading. And these individual investors just scream bloody murder. They're like, you betrayed us. You've sold out. You've caved to pressure from these big institutional investors and from regulators. So he doesn't have any friends there right now. But then on the other side of the coin, the big institutional investors are blaming him for creating all this chaos in the markets, for inciting all this speculation and risk taking, and just creating all these really unhealthy investing trends that aren't pegged to fundamentals. So he's just kind of in no man's land at this point.
Yeah.
I mean, I don't know if he's a winner or a loser at this point, but he's definitely a controversial figure. So it's crazy. I mean, there's just, you couldn't write this. In fact, we were talking about this yesterday. I mean, they're going to create a Netflix. Netflix has already green-lighted a movie about this whole GameStop thing. And
it will be glorious, I'm sure.
It will be.
Well,
I wonder if he's going to play Keith Gill.
Let's see. Keith Gill, one of the Wilson brothers. Which one is it?
Owen.
It looks like Owen Wilson. He's got Owen Wilson written all over. Just put the headband and the wristbands on him. Well, when you say it went crazy, I mean, that's not an understatement. Here is what you said. Yeah, 357.51 at its peak.
Yeah. So this chart here, this goes back to last summer. It starts out in June. And as you can see, GameStop was just putzing along at like $3-4 a share up until late summer. And then you see the bump, and then it really took off after the first of the year. It just, and it peaked at $357.51. And that was the closing high, but there was an intraday high. At one point, it was almost $500 a share. Now, it didn't close at that price, but at one point, it was trading at almost like $483. So if you look at that, I mean, that chart, it shoots. I mean, it looks like an EKG reading or something. That's what my heart did when I first met Brooke up in Snowbird.
Oh, so you just scored some points, my friend. You just scored some points. Let's talk about that number for just a second. I want to put that in a little bit of perspective, because at that market cap, and for a brief moment, because we see what happened the very next day, but just for a brief moment, at its zenith, GameStop, little bitty, you paid $100 for that game. We'll give you $7 for it. GameStop was worth the same amount as Bridgestone. All right. Bridgestone makes tires. They make rubber products. Those are things we can see, right? They've been around a long time. They were worth the same as LG Household and Healthcare, the folks who make everything from CAT scanners to televisions to washers and dryers. Kroger, the massive grocery chain. Weyerhaeuser, one of the biggest paper companies in the world, and Sirius XM, which is now, I think, standard equipment in almost all new cars.
Yeah. Delta Airlines.
Yeah. Just
Delta Airlines.
Yeah. So it's amazing what they went to. Now, when we're going to talk about what they dropped to, and I've got a few references there as well, but these are all names that you know. So let's take a look at this next graph, shall we, Shawn?
So this shows GameStop's stock price year to date since January 4th, which was the first day that the markets were open. And as you can see, it peaked there at almost $350 a share. And then it dropped. The bottom came out. They restricted trading, and all the momentum just completely froze. So it dropped way down to about $200 a share, and then it got some more life in it towards the end of the week, and then it came back down again. So right now, the last I checked, it started off the day in like the $90 range. And the last I checked, it was trading around $65 a share. So it's lost a lot. This chart, there's a chart here that shows how the overall market right here, stock market 2021. So when people look at the broad stock market, there's an index that they use, the S&P 500. And what it is, it's an index which is a basket of 500 of the largest publicly traded stocks in the country. Big names, Delta Airlines, Walmart, Amazon, these big companies. And because these companies are so broad, they represent about 90% of the total stock market, and it's a good reflection of the economy. So when people want to just get a quick read at what the stock market's doing, they can just look at the S&P. And it's been pretty flat, as you can see, throughout this year. I mean, it's just kind of bounced around. It was as high as about 3% at one point. It's dropped down to about down a percentage point or two. So it's been, what GameStop has done is just completely completely opposite to what's actually going on in the market right now. It's just this anomaly.
Yeah.
Really amazing.
Yeah. So, you talk about just look at that volume, that jump. That's amazing. It shows you the power of social media and people kind of jumping on the bandwagon.
Yeah.
At one time.
Yeah, that's the number of shares that are traded in. So GameStop only has about 70 million outstanding shares. Okay. So on average, a few million shares trade a day. This chart here shows how many shares were actually being traded per day. And as you can see there at the peak, almost 200 million shares were traded on that day. So that means if there's only 70 million outstanding, that means people are buying it, selling it, buying it, selling it. I mean, there's just tons of action, right? It's just moving, it's flying. And that's a good, it's volume. That tells the story as well as the share price. So yeah, it's just crazy. So yeah, let's talk about the market cap of GameStop. I keep saying GameStop.
It is a tongue twister. It is a tongue twister.
So, like I said, there's about 70 million shares, and I checked this morning at 9:30 this morning, shares were trading at about $85 a share. So we multiply those 70 million shares times $85, and we get a total market cap of $5.95 billion. So that's what size the company is. It shows us about how big the company is. So $5.95 billion in market cap. That's to put that in perspective. The company Crocs that makes those little rubber sandals that everybody loves to wear. People like wearing their PJs and shopping with Crocs. Crocs has a market cap of about $5 billion. So they're about in that same range.
So is Michelin, which again, tires, stuff. Dollar Tree, Clorox. Who does not have a Clorox product in their home right now? So this is Tyson Foods, which is all over the grocery store. It's not just chicken. McCormick and Company, the big spice company that's been around forever. Con Ed, which provides electricity to the entire northeastern United States. The NASDAQ itself is valued at less than $5.95 billion. If you look at how the NASDAQ itself is traded, and Suzuki Motors, which makes everything from motorcycles to cars to you name it. So yeah, it has put it in some pretty elite company, to say the least. But is it going to stay
a wild
there?
Ride? Yeah, it's just been a wild ride. So, and this will help put it in perspective. So if you'll look in the bottom left-hand corner there, when GameStop was trading at about $4 a share this past summer, its market cap was only $280 million. Okay. So it went from $280 million market cap to this past week when it closed on January 27th, the company had $24.3 billion. Its market cap increased 86-fold. 86-fold. So, I mean, it went from basically a dwarf star to a red giant, like a 6-month period, right? And then since last week, it's come back down to earth a little bit. As of today, it's a $5.95 billion market cap.
Wow.
So it's gone from being a red giant, now it's like a neutron star. And
still,
Hopefully it doesn't wind up a black hole. I don't know.
So yeah, I think that the black hole imagery is a great way for us to talk about what does this mean for the little guy? What does this mean for the average investor? If I'm sitting here thinking, okay, I'm a betting person. I'm willing to take a risk. I'm willing to try something. I mean, should I run out and get a Robinhood account or a Webull account? Should I jump on the Reddit? What do you call them? The subreddits and start looking for advice and should I start cleaning out the bank account and put it into some of these stocks? Should I try to short some positions? What do I do, Dr. Percap?
It sure is tempting, right? I mean, who doesn't get excited when you see stuff like this? And I think what people need to understand and what people need to recognize is call it what it is, okay? And wild speculation and just herd mentality, taking your investment tips from an online message board or a 16-year-old kid who's making a pizza, that's speculating. That's speculating, and it's really not any different than gambling, okay? So I'm not saying don't do it, but understand the risk you're taking and don't kid yourself into thinking you're some kind of stock marketing guru analyst. You're just making bets. You're making bets. And the thing you got to remember is in order to be a stock picker, it's like being a sports bettor. You've got to be right about 55% of the time. That's the only way you're going to make money is if you're right more than you're wrong. And it's extremely risky and it's hard work. Trust me, this Keith Gill guy, I'm sure he was putting in plenty of hours in his basement. And I think people think, it'd be easy. I could just do it and hang out at home and I could quit my job and just sit on my computer. It's like anything else. There's competition. There's other, it's tough. These big institutional investors spend hundreds of millions of dollars on research, and they develop these highly sophisticated computer trading algorithms that spot trends, and you're competing against all of this on your laptop or on your phone, and the odds are enormously stacked against you. So recognize if you want it as a hobby and you don't play around with more money than you can afford to lose, just like the same advice I'd give somebody who goes into a casino is the same advice I'd give somebody who wants to try their hand at this day trading stuff that, so many people are captivated by. For most people, buy and hold is the way to go. You pick investments based on your risk tolerance. You develop a plan, goals, a timeline, and then you choose investment products based on that plan. But what we're seeing here is the opposite. It's just let's just buy these investments, trying to make a quick buck, and it's a very, very different type of dynamic than what I think people like to think it might be.
So, how much does groupthink play into this? Let's talk about the psychology of what's been happening. I used the word bandwagon before. You talked about the amount of stock that was being traded, the number of shares just skyrocketed. And you had people like this 10-year-old kid who sold his stock. He decided to get out. And you've got these folks on Twitter now and on Reddit who are like, no, hold it. Make the big guys suffer. Make those hedge funds suffer. Let's squeeze everything we can out of them, make them pay. How wise is that advice for the average investor when we really don't know what's going to happen?
It's not, I think, and a lot of it, the media is painting this romantic narrative, this David and Goliath, Luke Skywalker versus Darth Vader narrative that is so captivating. Who doesn't love an underdog story, right? But the reality is that a lot of these holdings, some of these hedge funds, there are pensions that hold hedge funds. There are large institutional investors that hold retirement accounts and other types of investment accounts that could be impacted by this in a negative way. So, there's just the ripple effects are huge, and it plays out in so many ways. And I think people need to understand it. It's, when things like this, it's this hurt. Social media is so powerful, and that's really, I think, what's so captivating about this story and why it's getting so much attention is because it was driven by social media, and there's this little guy aspect of it, and we saw it earlier. We've seen it. We saw it with the elections in terms of social media and the protests, and I think every day we just continue to be blown away by how powerful social media has become in this country. We saw it earlier this year or last year. We're seeing it again. And now it's into the financial markets. And I don't think anybody really understands just how powerful it is or how it really works. And the way a message can be shared so quickly and it can be scaled so quickly and so powerfully. It is truly just amazing to think about. And the concern is now, well, can people do this with any stock? Can they do this with any investment? And right away, after they restricted trading in GameStop, you saw people moving over to the cryptocurrency markets and trying to generate the same kind of momentum with Bitcoin and these other cryptocurrencies. There's hundreds of them out there.
Well, they limited silver yesterday.
Silver, it was moving into the commodities markets as well. And right away, they started restricting trading and margin trading, and borrowed money and things like that. But people are concerned about that. Like, are they creating systemic instability in the markets? Is this something that we have to really worry about it? And then it's not even just a matter of, well, just regular investors. What if there are all these concerns with foreign governments tampering in our elections? Well, what happens if a foreign government suddenly decides, well, let's stop worrying about elections. Let's start sending out weird social media messages about the stock market, and could that create a market collapse? So it's going to be really interesting to see how this all plays out over the next few months and even years, and see what kind of role the regulators play. It's definitely, we're going to see some big changes, I think, for sure, in terms of how these online trading platforms operate, in terms of how individual investors are allowed to invest money, in terms of there's already restrictions on day trading. You have to have $25,000 in an escrow account. You can't make more than 3 trades. If you make more than 3 trades in a 5-day period, you're considered a pattern trader or a day trader. And I think we're just going to, and there's certain restrictions on margin trading in terms of, using borrowed money to trade. And I think we're just going to continue to see a complete overhaul of those rules and many others.
Yeah. Yeah. We have a couple of comments. And by the way, if you're with us, we've got just a few more minutes left. If you want to drop some comments, if you want to drop questions for Shawn in the comments section, we can pull those up and we can talk about those. But we got a couple of comments from a person who is actually a social media pro. And Lorelei says, I think it's awesome, LOL. And yeah, we do too. I mean, I love it when the little guy can get involved and start learning. My question is, can the little guy catch up in terms of learning the rules as fast as the big guys can change the rules? Lorelei also says, preach every day. The message is the most important outreach in social media marketing. Absolutely. Look how fast this message got out, and look how fast people were able to take action on this and change the market in just a snap. So Shawn, back to that question. The little guy doesn't write the rules. And if the big guy's going to make sure that they put pressure on platforms like Robinhood and Webull and all these others and say, you can't trade this anymore. You have to either hold your position or you have to just close out your position, but you can't buy anymore. What does that do to the small investor who does want to go up against the Goliath?
It's bad. It's bad. I mean, I don't see any way around it other than to say that they'll be disenfranchised if that happens. But I think one thing we have to remember too, though, is, the markets have always been weighted very heavily in favor of institutional investing. And, I heard all this talk over the last week. Oh, the markets are rigged. The markets are rigged. Well, some people will tell you the markets have always been rigged. I mean, if you go back 10 years ago and when all that news came out about high frequency trading, and word got out that these big institutional investors, they're able to trade over computers, and they have special networks and special algorithms that allow them to get their trades in faster than regular little guy investors. And it allows them to buy investments at lower prices. And they have these special exchanges called dark pools, which are like these anonymous exchanges where all the transactional data, it's anonymous, and they're able to just make a killing in those dark pool markets. It's happened before, and everybody gets outraged and it's rigged. But at the end of the day, you really have to ask yourself, well, where are you going to put your money? Where are you going to invest your money? I mean, sure, you could start a business, you could buy some real estate or buy apartments and become a landlord. But I think for most people that are just, a regular person that has some money that they want to put away, and they want to get a better return than what it would get in a bank account, but they don't want to take the hassle of starting a business and taking on that huge responsibility of a career like that, or becoming a landlord and being woken up at 3 o'clock in the morning because you have a leaking toilet or something like that. The stock market for a lot of people is still going to be a good place to put your money. Sure, it's weighted heavily in favor of institutional investors, but that doesn't mean for just a regular person taking a buy and hold a strategy that you can't still do really well over the long run. But again, you've got to be realistic, and you've got to do your homework, and you've got to have a plan. And that plan's got to be a little bit more sophisticated than I just want to make a killing in the next 2 weeks.
Right. So while it can be a get rich quick for some people, I think for most people it is a get rich slow mechanism. You mentioned those pension funds, you mentioned those 401ks and things like that. And, hedge funds get a bad rap in the media. They get a bad rap in front of Congress and things like that. But so do the big banks and the brokerage houses. But you got a lot of retired teachers. You got a lot of barbers and nail technicians and pet groomers and people who have taken the hard-earned money that they've put into their business, and then they've invested it into this broader market. So we need all those folks. If we got just a couple minutes left, Shawn, what are a couple of takeaways that people need to think about as we leave this, as they go into thinking about their own investments, their own future? What are some things that they need to keep at the top of their minds?
Well, one thing people need to, if you're going to invest your money, you really need to decide how actively involved you want to be in that process. Do you want to be a hands-on investor? Do you want to pick your own stocks? Do you want to do all your own research? Do you want to make your own trades? Or do you want to be kind of hands-off? Okay. And you just want to, you want to put your money in an investment, let somebody else manage it. You don't necessarily want to check your valuations every day or even every week. Figure out where you want to be. Which one of those roles do you want to assume? And if you want to be a hands-off investor and you want to go long-term, look at mutual funds and look at other types of, managed investment accounts that you don't have to do a whole lot of work in other than just kind of supervise and make sure everything's moving in the right direction. If you want to be more involved, you want to be a hands-on investor and you want to trade individual stocks or get involved, I'm not going to discourage somebody from doing that, but that's a very different approach, and you're going to have to put a lot more time and a lot more effort into that in order to make that happen. I think people really need to just educate themselves more about how stocks work, how the markets work, understanding more about companies and fundamentals as well. Those are all important. And of course, just understanding your risk tolerance, how much risk can you take? How much can you really take on? What kinds of stocks are going to be more risky than others, or what types of fixed income investments are going to be more risky? And at the end of the day, for most people, the stock market should not be a place where you try and get rich. When you invest money, what you're really trying to do is you're trying to grow your capital in order to offset the eroding effects of inflation at a rate that's in line with your chosen risk tolerance. Okay. It's really about just taking what you have and growing that money, but growing it in a responsible and manageable fashion. And I think you might end up rich. If you stay in it long enough and things go your way, you could wind up rich, but you really shouldn't go into it with that mentality. If you want to really get rich, you probably should go to Sequoia Fund and take one of Russ's entrepreneurship classes, entrepreneurship or something like that. Because that's really where that's a better option. Really, it really is. Getting some great new business going, developing some product. That's probably going to be a much better strategy if that's your goal.
Well, Shawn, I appreciate the plug. Thank you so much. Listen, friend, our time is up today. We're going to watch this thing keep developing. We're gonna watch it happen again and again, I'm sure, in the future. But I appreciate you coming and spending some time with us today, educating us about this and enlightening us on what's going on. And let's make sure we got no. Hey, look here. See, woohoo, Shawn. We got people love you. People love you, my man. Folks, I appreciate you coming to join us today. If you can indulge us for about 30 more seconds, I have a shameless promotion we're going to throw your way, especially if you are an enrolled member of the Cherokee Indians. And if you live in Western North Carolina, this is for you. For those of you who are not around here and you got to take off, we understand. Thank you so much. We'll see you the next time on the next Live with Sequoia Fund. Thank you, Shawn. We'll see you again soon.
Thank you, Russ.